So rollover excess contributions are those contributions that you contributed in excess of the maximum allowable contribution deduction that we just looked at in the previous session. And then Section 10C is a new exemption that came about 2-3 years, or I think 2 or 3 years ago, in terms of these excess contributions and how you can also use them to not lose those additional contributions that you made in excess of the allowable contribution. All right, so as I've already mentioned, that whenever you contribute in excess of the allowable deduction, those excesses will accumulate and it will roll over from 1 year to the next. And you are able to use those somewhere in the future in different ways. So the first way that you can use it is as a deemed contribution. Now, a deemed contribution is as if you contributed to the retirement fund in that specific tax year. So it might be that you made contributions to a retirement annuity and then for some reason you stopped. Maybe because you've already contributed sufficiently or whatever, and you decide to cease your contributions or to make the retirement annuity paid up. What you now can do is to then these accumulated excess rollover contributions that you couldn't use in previous tax years, you can now use them in future years when you are below the deduction limit, as if you made them in that year. So you won't lose those excess contributions. You can use them, as I just explained, as deemed contributions. The second way that you can use it is to reduce the taxable portion of your lump sum. We've already discussed this in the first lesson in this tax implication section. So if you have a lump sum, you have excess rollover contributions, you can deduct that from the lump sum being received in order to reduce the taxable portion of that said lump sum. The third way that you can use it is by using Section 10 capital C, an exemption. And I'm going to look at this in a little bit more detail, but basically what it is if you've bought a compulsory annuity, important compulsory annuity, and the source of the funds in that annuity comes from a pension fund or a retirement annuity fund, then you can reduce the income by the excess rollover contributions in order to not pay income tax on that income for as long as you've still got excess contributions you can use against it. It's on a first come, first served basis, so it's not in this order. It's not that you first need to apply it as deemed contributions and then apply it against lump sums and then Section 10C. You can use it for whatever you like, or the client can use it for whatever they like. First come, first served. So if there's a lump sum today, you use it against the lump sum. If there's nothing, you can use it as deemed contributions. If you've bought a compulsory annuity, use it as a 10C exemption, and you can actually apply it for all three of those in the same tax year as well. So no concerns or rules around how it can be used, but these are the three places where you can in fact still use these excess contributions. Now, if you have any rollover contributions left by the time you pass away, in other words, there were contributions that you were in excess of your deductions, but you never used them for whatever reason, then that amount will be a deemed asset in your estate. So they will include it as part of your estate, and therefore there might be estate duty payable, etc. On those values. So Section 10C exemption, let's just quickly have a look at it. This is only applicable to the 2/3 that comes from a pension fund, a pension preservation fund, and a retirement annuity. And you must have bought a compulsory annuity. Now, it doesn't matter whether it's a living or a life annuity. That doesn't matter. It also doesn't matter if you use the full fund value of that pension preservation or RA fund to buy it. So in other words, you use the full 3/3. It doesn't matter. As long as it's a compulsory annuity and the money came from one of those three products, whatever amount, then you can apply Section 10C. If the money came from a provident fund, or you have a living annuity where you had money that came from a pension fund and from a provident fund into the same living and life annuity, then you can't. So it's got to be pure. So wherever you have a provident fund, you must buy a separate living annuity with that if you want to use Section 10C. In practice, you can combine all of that into one living annuity. This has only got to do with, can you use Section 10C or not? And the only reason why, or the only time that you need to consider this, is if you in fact have any excess rollover contributions that you want to utilize. If the client doesn't have, then you will ignore this and it doesn't really matter. All right. And then just to remember that although it excludes the provident fund, when we look at the retirement fund contributions, so where the excess amounts came from, it doesn't matter what type of fund you made it to. So all of the contributions to all of the funds, so pension, provident, and RA fund, will be used for the excess contributions, but only compulsory annuities bought with money from pension and pension preservation and RA funds will qualify for the 10C exemption. So very, very simple high-level example. John belongs to a pension fund and he has 300,000 in previously disallowed contributions. Doesn't matter where that 300,000 came from, how it's made up, what type of fund it was made to, there's 300,000. He now retires from the pension fund and decides to use the full value to buy a pension. So he's not taking anything in cash. So he couldn't offset that 300,000 against a lump sum or anything like that. Because the annuity is bought with money originating from a pension fund, Section 10C can be applied. And therefore, on the first 300,000 in annuity payments that he's going to receive, that will be exempt. Because they can deduct the 300,000 from whatever pension he's receiving. So until for the first 300,000, as soon as he's received 300,000, then anything above that might then be taxable again. Alrighty, so that is the excess rollover contributions. In this lesson, before you get to your last challenge, I'm going to look at income tax and the implication on different sources of income. It's important to be aware of this.